This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Tuesday morning. It's a morning where we are clueless, not clueless, but clueless. No US markets overnight. US markets were shut for a holiday. I'm Prashant. With me, my colleague Sonia and Surabhi. Guys, hi, morning.
Good morning, guys.
I don't know about you, but sometimes I'm clueless also, along with being clueless, right? That's the way of the market, perhaps. I mean, we have been having this fear of heights, so to speak. Just a matter of time, I guess, before the new highs hit. But for now, patience is a good virtue to have.
Yeah, I guess, but you know what? You can't ignore the selling as well, right? Because it's not like, 5-10 points here and there dithering along. These days, I mean, the selling is getting a little more pronounced as well.
We saw that yesterday, right?
Yeah.
And I think you're absolutely right. We should not ignore it because it's coming after what has been an absolutely spectacular move. And I think, if anything, what yesterday shows us is that one needs to sit up and take notice. We said this yesterday as well when we put out the fact that the broader market markets were overbought, the RSIs, etc. I'll get to that in just a bit. But yesterday's price action, and by the way, our colleague from the digital side, Hormuz, points out that this is the first negative start to a week since April. I mean, I think 16th or 17th of April. So it's been that long that we've not had a start to the week which was down. We had one yesterday. Now, this does raise doubt whether the move that we started at about 18,050 is starting to get a little mature. This is not to say that the overall bigger trend is changing or anything, but in any up move, however strong, however long-lasting, there are turns, there are dips, etc., which happen. And I think one should be cognizant of it, especially if you are trading. I mean, if you're investing, I mean, I think, and if you have been investing and if you've seen stocks go up, I mean, you just sit tight. But if you're trading, I mean, I think you have to listen to the market and do what the market is, or rather go where the market is taking you to. So, I mean, you've got to sort of crystallize these in terms of levels. Initially, watch for the Nifty. Hopefully, it stays above the lows on Thursday, which we made at 18,669. Remember, Thursday we had a negative, we had some selling, serious selling. Friday, the market respected the lows from the previous day and then had a positive day. Yesterday, of course, you saw what happened, selling after 12:30 mid-afternoon. So Thursday's low, in a way, becomes the first one. 18,669 is that level. But to say that, at least in the near term, the trend is changing, you need a close below the 20-day moving average, which is some distance away. That only stands at 18,585 as of yesterday's close. So those are two levels. On the upside, of course, I mean, we got to within 7-8 points of the all-time high, so we know the levels to target if indeed that were to happen. On the Bank Nifty, I mean, by the way, the Bank Nifty is already below the 20-day moving average. The 40-day exponential moving average, the level we put out yesterday as well, we are still above it. That number is 43,452 as of yesterday's close. Hopefully, maybe we test it. There is a bit of a sort of time spent around those levels and we come up in the best case kind of scenario. Otherwise, it's a bit of a deeper correction on the Nifty Bank as well. The Nifty Bank actually has been the weaker of the two indices for some time now. It's been dithering and maybe we're starting to see the first signs of some cracks. Mid-cap and small-cap indices let off a fair bit of steam, right? So we put this out yesterday as well. Mid-cap index RSI, relative strength index, was 86. Small-cap index was 84. Anything above 70 is overbought. We got a cool-off. I mean, indices ended flat, but they were up almost 1%. From being up 1%, they intraday cooled off and ended in the green, but absolutely flat. So, again, I mean, if you're trading, you want to pay attention to these signals in terms of what the market is telling you, that maybe it just wants to consolidate a little bit, move a little sideways. In terms of a deeper pullback, we will see once those levels I put out are breached. U.S. markets were shut overnight, so as I said, we don't have very much by way of cues from there. The headline yesterday evening, our time, was, of course, I mean, the U.S.-China meeting between President Xi and U.S. Secretary of State Anthony Blinken, and Xi described it as the meeting being very good. It was, of course, lacking in any concrete detail, but that is important to note as well. Prime Minister Modi, of course, starts his U.S. visit from tomorrow, and that will be, of course, top of minds over the remaining course of the week as well. But that's a little later. For now, I mean, keep an eye, be watchful of the market and the signals it wants to tell you. SGX, I think, is indicating about a 67, 70 odd point lower start. We've been saying that immediately, I mean, dips are good and the dips do get bought. But I would say hold off, at least even if you get a 70-point lower start, hold off for the first hour, 1.5 hours, see what the market is saying. Maybe the dip gets a little deeper and then decide. Once you're closer to those levels I put out, to decide to act. So stay put and watch the market. Let the market tell you what it wants to do. Sonia.
Oh, absolutely. And, you were talking about how there is definitely caution in the system. You can see it in the banks, right? That's the biggest drag on the index. Not just yesterday, but for the last many days. I mean, the Nifty is not only struggling to conquer all-time highs, but look at the Bank Nifty. The Bank Nifty is now down 500 points from the 13 June high of around 44,100. And I want to pull up Kotak Mahindra Bank because in the month of June so far, in 20 days of June, Kotak Mahindra Bank is down 10% already. Others like ICICI Bank are also down about 3-4%. But the Bank Nifty is the one that's really dragging the market lower and preventing the market from hitting all-time highs. So that's one pocket. The other thing is both foreign and domestic investors have been selling in the cash market, and that's not a good thing. So yesterday, FI sold about 1,030 crores, large amount. DI selling was not too much, but just a little under 400 crores of selling from DIs as well. A couple of things that I'm watching out for. Of course, the US markets were shut overnight, so we don't have any cues from there. But all eyes will now be on Fed Chair Jerome Powell, who will be testifying in front of the Congress on Wednesday and Thursday. So we will be watching out for any commentary on that front, what happens with the next meeting. You may not get any signs of whether they will hike rates or not in the next meeting, but some commentary will be crucial for sure. In earnings, there is a FedEx that reports their numbers, later. So later on Tuesday. So we'll, keep an eye out on that. Apart from that, in stock action in our own markets, there's HDFC AMC, which will be in focus. Aberdeen is looking to sell their entire 10.2% stake in a block deal. That's source-based information, so we'll keep our eyes peeled on that. And Indigo, of course, Surbhi was talking about it yesterday as well. We'll focus on that today. The deal is finally done. They've ordered 500 aircrafts from Airbus worth $50 billion. And this is the single largest deal in the aviation industry, in the history of the aviation industry, by one single player. So, of course, it assumes a lot of importance. More on that in a bit. But overall, I think for the market, some caution is definitely needs to be taken on board, especially with what's happening with the Bank Nifty, where private sector banks are big laggards now.
Oh, yes, absolutely. And caution across Asia as well. I mean, look at the way these markets are trading. Again, it's not the kind of move that you can ignore. Should pull up the Hang Seng. And the SGX Nifty is mirroring that. I mean, we're looking at probably a 50-point decline at the start if you go by the SGX Nifty. So these are decent cuts coming across Asian markets. And this despite that the Chinese central bank has delivered on expected lines by ushering in more rate cuts. So because of that, we'll watch for the metals market. And I would have said that maybe we'll get a nice metals rally. But given the mood, looking at the way Asia is trading right now, I'm not sure if we'll get even that metals rally or not. Now, what has the Chinese central bank done? The cuts are along expected lines. We're talking about 10 basis points in the 1- and 5-year loan prime rate. And remember, the cuts started last week when we had that reverse repo rate cut around 10 basis points and the 1-year MLF cut happening in China. So all of it is moving along expected lines, and markets are not too enthused right now. So let's see. The other thing is, while China is cutting, maybe this is a market, markets around the world, repricing the reality that the Fed will hike. If you look at the CME Fed Watch tool right now, the probability is as high as 75% of a 25 bips hike in July. So maybe that needs to go through the system, that if the market around the world was hoping we'll quickly start seeing rate cuts by the end of the year, maybe that's not the reality, and that repricing needs to happen. And perhaps that's what we're witnessing right now. Which brings me to the FPI flows picture. Sonia was mentioning yesterday's selling. If you look at June has sobered off compared to the major numbers that we were getting in May. So let's pull out the FPI inflow tally as well. June's inflows are now just around, I think, 16, 17. Yeah, there we go. 17,000 crores, just under that. And we're, rounding up on the 20th of June right now. May was this blowout month. The rally started in April. That's when the FPI flows turned positive. Feb and January were absolutely disastrous. So let's see. We need to watch this FPI screen also in some detail. Now, that brings me to this underperformance on banks that Sonia has been talking about. Prashant mentioned it as well. So in the month of June, the Nifty is up just about 1.1, 1.2%. Banks are down 1.5% thereabouts. The IT index is the biggest underperformer. So one question that I'm asking is there any end to the IT underperformance? Look at the way the IT part of the market started seeing some accumulation yesterday, even in a fall. We need to see if that's a trend in the making. But the bigger watch point is going to be the mid-cap rally, this absolutely breathtaking move that we've seen. The micro-cap index is up 7% this month, the month of June. Mid-cap index up 4-5%. So the key question that I'll watch out for is that if we start falling at the headline level, not just stalling, but maybe cooling off, then will the mid-cap rally become vulnerable? So, some watch points. Today, by the way, Sonia, you mentioned Airbus. Today, all the railway stocks are going to be in focus as well, because there's some very interesting, developments with respect to the RVNL order. Seems there might be a cancellation there in rebids. So we'll see. I mean, mid-caps have had this flourishing move. But I wonder if the headline indices start falling and whether that can remain on track.
Well, people are not too concerned. I had a chance to chat with a few market experts, and one of them, actually, Gautam Dugar of Motilal Oswal Financial Services, expects the market to trade range-bound with a positive bias. So give and take everything, he expects the markets to have a positive bias going, especially in mid and small caps, which are showing better momentum. He expects that to continue. He adds, after a long time, both macros and micros are doing well together. They continue to stay positive on consumption with a preference for ITC, Britannia, Titan, Metro and Indian hotels. NBFCs offer a good tactical trade, so some reallocation from banks towards NBFCs can be prudent.
Okay, let's get you some money market views now. This is Rupee. On the Rupee, Abhishek Goenka of IFA Global saying that the dollar is weakened against major currencies post the Fed and the ECB rate decision last week. The Rupee too has appreciated by about 0.6%, tracking broad dollar weakness. June is on course to become the fourth straight month of net FPI inflows into domestic equities. Dollar Rupee pair is now approaching the lower end of the 81.6 to 82.9 level. And the risk to the view on rupee appreciation stem from the underperformance of the yuan and weak May trade deficit.
And on the bonds, Ajay Magnolia of JM Financial says globally yields trade at elevated levels amidst uncertain trajectory of monetary policy. He says UK yields too hardened in expectations of a hawkish policy decision this week. He says Indian bond yields are trading at the upper band, driven by overnight index swaps and a lack of positive cues in the auction cutoff seen on the higher end for demand-supply equation. Ajay says positive sentiment is slowly fading away and liquidity remains an issue. He adds that state loan auctions expected to inch up a bit today compared to last week. He expects the 10-year benchmark bond yield to trade in a range of 7.03 to 7.08% for the day.
Okay, we have lots of stocks to watch out for as usual. So in just a bit in our top 10 segment, we will cover the likes of HDFC, Interglobe Aviation and Coforge. That's on the back of positive news flow. There's HDFC, AMC, Timken India, Ather Industries, RVNL, BHEL, Titagarh Wagons and IIFL Securities. Now, these could perhaps be on the red side today. More details coming up.
Okay, well, let's get some quick global perspective now. Phu Hein Yap is a senior investment strategist at Standard Chartered Bank. He's joining us now to take some questions. Mr. Yap, good to have you with us here. Thanks very much for your time. So there's been some talk that over the next 1 month, over the course of the next 1 month, in the US, we will see a very large amount of liquidity contraction as the US Treasury rebuilds its reserves. It's able to do so now because the debt ceiling is no longer an issue. It perhaps is one of the largest we will see in a single month. Will that, to your mind, have an impact on equity markets? What's your view?
Yeah, thanks very much for the question. Very good to be here. Yeah, we have looked at that and we've discussed it before one of our publications. We think it will be manageable. It has been well flagged. If anything, the whole issue about the debt ceiling was discussed. When it was resolved, it was seen as a positive thing. The thing about the liquidity drain, we think it is something that's very well expected by the market. And we think that it will be something that can be managed, can be digested by the market.
Phu, good morning and thanks a lot for joining in. How are you approaching, as an investment strategist, how are you approaching emerging markets like India now? This has not been such a great year for India if you compare it to a lot of, the global peers like the S&P 500 and the Dow. Give and take everything, the rally has been just under 5%. What is the expectation for the rest of the year and where do your preferences lie?
Yeah, thanks very much for that. I mean, we do take a 6 to 12 month view, and within the global equity space, we still prefer Asia. Okay, so we prefer countries like India, China, and Japan as well. We think the trajectory for that is towards more growth. The China, I think we've seen some rate cuts there, just showing that the policymakers there are quite serious about growth, and they want to be able to stabilize growth. We think we see the prints in India macroeconomic growth is very, very strong, and the RBI is signaling that they're already holding off in terms of further rate cuts and taking a bit of a pause. And in Japan, we see a lot of the Tokyo Stock Exchange trying to prompt the companies to improve the return on equity for companies with a very low valuation. So we do see the whole region in Asia as being preferable to the US and to Europe, just because we think one is the policy is a bit more supportive for growth there. Valuations are more attractive, and as opposed to being in the US and in Europe, where there's the signals of more rate hikes to come, and the intention there is really to fight inflation, to slow down growth. And that is something that the policymakers are very clear that they want to do. And because of the different point of the cycle, really, I would think Asia is much more attractive. It requires some patience. We see that in China, it ran up quite a lot at the start of the year, and then came back down for various reasons. But we think the geopolitical risk, some of that is being mitigated with visits like Antony Blinken and various business leaders that we are visiting in China.
Phuc, hi, good morning. So you seem to like all three markets, right? India, China, and Japan. Within the three, what's the pecking order? Because we've been hearing a lot of commentary that seems to suggest that money will keep moving out of China, and that money will probably find a home in Japan and in India. But what is your own preference?
Yeah, we do not have a pecking order at the moment. At some points of time, we do, but at this point of time, we do not. I mean, within those markets, including Korea and Taiwan as well, I'll throw that into the mix. We have between those countries quite similar views. But the distinction we try to make is Asia versus US and Europe. And that's where we think the opportunity is. Look, I mean, each market has their own pros and cons, right? I mean, they are good for the reasons I cited. But then in India, we see the valuation is very high. It's come off its peak, but it's still very high relative to countries like China. China has to contend with geopolitical risk. Japan is seen as being cyclical. So there are pros and cons for each market. But overall, I would say that we like all these regions within Asia, especially relative to the US and Europe. And that is how we're talking to investors, to talk to investors to rotate towards Asia. But at the moment, I'm going to be unable to give you a pecking order between those countries. We do not have a house view there at the moment, yeah.
Right, that's some Southeast Asia supremacy, right? You like India, Japan, China compared to a lot of the global peers. Great to hear that. Phuc, appreciate your thoughts. Thanks a lot for joining us and speaking to us on CNBC TV 18. Well, let's slip into a quick break on that note. On the other side, our entire team will be with us to help us prep for the day and tell you all about the top stocks you need to watch out for as we begin a brand new day of trade. Welcome back. Well, the financials have been under pressure and that has been dragging the markets in the last few days. So let's see how it shapes up today. The SGX Nifty is indicating that there could be a further downtick of 70 points as we kick off trade. So lifetime highs continue to evade the Indian markets. Nevertheless, a lot of stocks in focus. Nimesh is here first up to tell us about HDFC AMC and why he's watching that one. Nimesh, hi, good morning.
Hi, morning, Sonia. So there is a large block in HDFC AMC. I did highlight it as well in closing bell yesterday. So Aberdeen is selling its entire 10.2% stake by a block deal today. The book was launched last evening. The indicative price is between 1800 to 1892, which means up to 5% discount to yesterday's closing price. It's a clean out trade and it will have an implication as well. So, Aberdeen is classified as a promoter entity. So post today's block, the free float will increase, which means that FTSE is likely to increase the weight of HDFC AMC as early as next week. And that could lead to an inflow of close to $17 million. The bigger thing is the MSCI inclusion. Remember, the stock is out of the MSCI. That inclusion may take some more time, and analysts believe that MSCI inclusion is unlikely before the August review. So, big deal, Aberdeen selling its entire 10.2% stake by a block deal, and it can happen at a 5% discount. So that's the reason why HDFC AMC could open in the red today.
All right, thanks a lot for that. Well, Indigo is the other stock that we're looking at. Of course, the news is well known and digested by now, but it could continue to be a positive trigger for the stock, and I'm going with green over there. This is the largest deal that has taken place in the history of the aviation industry. Indigo has bought 500 A320 planes from Airbus, and with this 500 planes, the total fleet goes to 1,000 plus planes, and the delivery of these new aircrafts will be completed by the end of 2029. Now, the earlier, the earlier largest deal was when Air India bought those Airbuses, but now Indigo has gone ahead and superseded that deal as well with 500 planes bought from Airbus. Now, Indigo is looking to further expand its international operations with this particular purchase. If you look at it in the last 5 years, from 2018 to 2022, the international business has grown at a compounded growth rate of 25%. The number of passengers, international passengers in 2018, for example, was 2.8 million. That has risen to almost 8.5 million in 2022, which is a 25% growth rate, and they're looking to grow that further. But a lot of this perhaps could be in the price as well, because the stock has rallied quite a bit. It's up almost 60% in the last 1 year. A lot of brokerages have raised their target price as well. Citi has a target price of 2,900. Morgan Stanley maintains an overweight with a target price of 3,126. And there is the Gangwal stake as well that, the 5-month lock-in ends in mid-July. So all eyes will be on that as well. But I'm going with green today.
All right. So we'll keep an eye. But let's move on to HDFC, which has got news flow as well. Ekta is here to tell us what. Ekta, morning.
Morning. Well, it's an important deal which has taken place for HDFC. They've divested 90% stake in HDFC Credila to two PE funds, which is basically BPEA EQT, which is Barings PE, and Chris Capital, for around 9,060 crores. This is one of India's largest ever PE buyouts in the financial services sector. So remember, HDFC Credila is one of the largest non-bank lenders in the Indian education financing market. It provides loans to those seeking higher education in India as well as abroad. Its loan book is at over 15,000 odd crores. The consortium valued HDFC Credila at a pre-money valuation of around 10,350 crores. They will be infusing primary proceeds of around 2,000 crores into the company. HDFC will continue to have around 9.9% stake in the entity. The transaction is subject to approval of the Reserve Bank of India as well as the Competition Commission of India.
Okay, so that's a big deal. Both HDFC and HDFC AMC in focus today. Ekta, thank you very much for that. Nimesh is joining in. Nimesh, some blocks, Timken and Ather on your radar?
So, okay, first on Timken India, it's come as a bit of a surprise that the parent is looking to sell a large block. They're selling close to 8.2% equity, which is 63 lakh shares by a block deal today. The offer price, the floor price is 3,000 rupees per share, which indicates a 15% discount to yesterday's closing price. It has come as a bit of a surprise for a lot of investors because the parent's holding is at 68%. So the entire 8% stake sale looks like more of monetization by the parent in the Indian arm. I understand the demand is quite strong, so need to see at what price the bid gets done. But to start with, the stock can open in the red, largely because it's a large block and at a discount of close to 14%. The floor price suggests a 14% discount to yesterday's closing price. Remember, even Timken was part of my charter by Dill Street Charter last week.
Okay, even more reason for all of our viewers to tune into the Deal Street Chatter that happens at 3 p.m., right? 3 p.m. every afternoon.
Just after 3 o'clock. Of course, Nimesh has all the buzz and all the news in the market. But we're not done with the blocks. I think you're also looking at Aether Industries, Nimesh?
That's right. In Aether Industries, Surabhi, it's not a block, but it's a QIP launch. The book was launched last evening. The company is looking to raise close to 750 crores. So the dilution is close to 6.2%. The issue price is at 936, which means a 6.5% discount to yesterday's closing price. The document very clearly suggests that the proceeds of this entire 750 crores will be used for capex, working capital, and for general corporate purpose. But Aether could start in the red because they're raising money via QIP and at a 6.5% discount to yesterday's closing price.
All right, thanks a lot for that. Well, there are some more stocks that are in the news this morning, and Vivek has the lowdown for us. Vivek, over to you.
Well, good morning. Quite a few railway stocks will be on the radar. First on our list would be RVNL, and then along with that, we'll have BHEL as well as Titagarh Rail System that will be on our list. Now, Money Control reports, we have not independently verified this particular news report. What they're reporting is that in the recent Vande Bharat train set order win, where, RVNL, along with its Russian JV partner, which emerged as the L1 status or the lowest bidder, Money Control reports that the JV talks have actually gone ahead and dissolved, and RVNL may no longer partner with the Russian partner, with its Russian partner for this particular JV to go ahead and deliver 120 train sets and also do the operation and maintenance part. Now remember, the size of the order is very large, 36,000 crore. That includes both the delivery of the train sets as well as the operation and maintenance part. Now what we need to understand at this point of time is actually the holding structure of the JV. RVNL, at the time of going for the bidding, actually held a 25% stake, and its two Russian JV partners held a total of 75% stake. However, post winning the bid, RVNL has now gone and asked its Russian JV partner for a 69% stake, which the JV partner has not agreed to, which has led to the failing of the stocks. Now, moving on to BHEL as well as Titagarh Rail System, these stocks too will be in focus. They were the L2 or the lowest bidder in the second status who agreed to match the L1 price and go ahead and deliver another 80 train sets. So at this point of time, there is uncertainty whether, that particular order will proceed or whether, the Indian Railways will go ahead and scrap the entire bidding process and go in for a new tendering order for the entire 200 Vande Bharat train sets.
Okay, that is important, Vivek, and we'll sort of come back on that with more later. But more stocks with news flow. Surabhi is here with that. Surabhi, morning.
Good morning. So first on my radar is Coforge. They had held an analyst meet and they've reiterated their FY24 guidance of 13 to 16% revenue growth and stable EBITDA margins. The company expects their margin to expand by 100 to 300 basis points in the medium term, and the management has also guided for doubling their revenue from $1 billion to $2 billion in less than 5 years. Nomura has a buy rating with a target price of 49.20, and Nuvama also has a buy rating with a target price of 5,500. Next on my radar is IIFL Securities, where SEBI has barred the company from taking on any new clients for 2 years. SEBI has found that company has failed to segregate its own funds from its client funds. They've misused the credit balance in their client funds and also inappropriately designated the client bank accounts. So on the back of that, IIFL Securities is expected to open in the red.
Okay, got that. We'll watch out for those names as well. Surabhi, thanks for joining in. Well, let's quickly recap our list of top stocks to watch out for today. The ones that have positive news flow around them are HDFC, Interglobe Aviation and Coforge, so just 3 on the green side. Stocks with negative news flow are HDFC AMC, Timken India, Aether Industries, RVNL, BHEL, Titagarh Wagons and IIFL Securities. Well, that's the stock list for the day, but let's also round up all the commodity market action. We have Manisha Gupta joining in with the latest. Manisha, hi, good morning.
Morning, Surabhi. Thank you for that. Well, we started many of these markets on the weaker side, but then the China cuts loan rates for 1 year and 5 year by 10 basis points, and that clearly has supported the market. So the crude oil prices, which started nearly a percentage point lower after falling 1.5% yesterday, are nearly trading a percentage point higher right now. Markets will watch out for the Iran oil output as well, where the output and exports both have hit a record highs. But with this China step, whether the demand from China improves is something that sentiment is what is working right now. Same is the case with the metal prices, whether it's copper, which is trading nearly 0.5% on the higher side, iron ore, steel, zinc, aluminum. I mean, we started slightly weaker. Remember, the U.S. markets were shut yesterday, so the volume were anyway on the weaker side. But after this China move, there is a lot of support that we've seen come in for these metals as well. Now, all eyes on the U.S. Fed Chair Powell testimony before Congress. That happens tomorrow. So ahead of that, there is some support that we can expect.
All right, Manisha, thanks a lot for that. Well, let's go across to Vivek now. He has a list of all the brokerages that are in focus this morning. Vivek, over to you.
Well, good morning. A couple of stocks to keep on your radar. Some positive brokerage notes coming in. First on our list is ICICI Lombard. CLSA today has come out with a note on the company. Number one, they've maintained their buy stance and they've gone ahead and raised the target price and also increased the valuation multiple that they were ascribing to ICICI Lombard. Now, what they're saying is that ICICI Lombard is growing faster than the industry in all of the segments, barring, the motor segment. In fact, the health segment has been growing the fastest, and this has been on a high base, which is why CLSA believes that there is more scope for an up move. Now, what they're saying is that the suppressed profitability as well as new accounting methodology is something where they are awaiting more clarity on, and they are also awaiting clarity on the magnitude on the ROE expansion. Now, despite that, they've gone ahead and raised the target multiple from a 26.5 times earlier to now 28 times. The other stock to keep on your radar, Bank of Baroda. Remember, this particular stock hit a 1 lakh crore market cap yesterday, and JP Morgan has come out with a note on the company. They've maintained their overweight stance. What they're saying is that market share for Bank of Baroda is something that is continuously improving. They're also saying retail loan growth is something at this point of time is even faster than its private peers, and the company has now come up with a unique model that is attracting talent from private banks. Asset quality has steadily improved for the company, and what they're saying is that there is further scope for improvement in ROAs, given the fact that the company still has significant levers on NIMs, costs, as well as provisions. On the back of that, they believe that even value crystallization as far as subsidiary is concerned could be an additional positive trigger.
All right, thanks very much, Vivek, for that. So lots to discuss, but that's the list of stocks that we are tracking, and we'll discuss with Amisha Vora as well. She's our guest on the program a little late after a quick break, Chairperson and Managing Director at Prabhudas Lilladher. So conversation with her on some of these stocks and, of course, her ideas. A little after that, we'll have the management of MTAR Technologies to discuss business outlook. Stay tuned. Both those conversations lined up.
Welcome back. Here with us on Bazaar Morning Call. And Amisha Vora, Chairperson and Managing Director at Prabhudas Leeladhar, is with us now. Amisha, good morning. Thanks very much for joining and always great to talk to you. I want to start off by an interesting, potentially interesting development on the railway side, right? We all remember what happened to a stock like RVNL over the last 2 months. They got this Vande Bharat order, and from, I think, 64, 65, the stock shot up to 120 plus, right? Now we're hearing maybe there will be a rebid, maybe there's some problem with their joint venture. How are you looking at this? Because these stocks have been really overheated. I mean, whether it's Titagarh, BHL, the entire lot. Do you still like this as a pocket of the market? And how would you approach it if that's the case?
See, as a pocket of market, the railway wagon or railway stocks are definitely going to do very well, because Vande Bharat order either will go, in case of this problem being real, to L2 or rebidding. But the order is definitely going to go ahead, and that's when the action will happen. And most of the financial tie-up for these kind of capex is very well done. So I believe that the railway stocks per se will continue to do very well, whether these three PSUs or beyond.
Amisha, hi, good morning, and always great chatting with you on the channel. You know, it's very perplexing to see how some of these private banks like Kotak Mahindra Bank are coming off. I mean, in the month of June alone, Kotak is down over 10%. What do you do here? Do you buy the dip? And what explains this underperformance?
So there are a couple of things here. In terms of quality, nobody has any questions as far as Kotak Bank is concerned. But the way the dynamics in the private sector banking is changing, and of course, the way ICICI Bank resurrected their entire strategy, basis which their growth, asset quality, ROA and ROE is on an improvement path. So there, the investors got a good delta. As we stand also, we think that the combination of HDFC Bank, post a little initial hiccup in terms of some of the mutual funds 10% limit, etc., will have a huge runway in terms of business growth because of cross-selling. So in that scenario, while Kotak Bank on its own is doing extremely well, I believe that the comparative landscape of private sector bank changing is leading to little change in weight and underperformance in the stock, as it was very well priced even before.
No, my question was more, what to do with the stock now that if you own it. I mean, should you be selling out? Should you be churning? But I'll come to that in a bit. Another stock that we wanted to discuss is MTAR Technologies. So let me just get the management on board, and then I'll come back to you, Amisha, for a quick chat on that. It's the first corporate on our radar today. So all defense stocks have been buzzing, as we know. The government's push for defense indigenization has gotten much stronger, and MTAR Tech has surged 50% in the last 1 year already. Srinivas Reddy, who's the managing director at MTAR Technologies, joins us now to discuss that, as well as the way forward from, this entire angle of how the government is sort of doling out orders and how they could be beneficiaries of that. Mr. Reddy, good morning, and thanks a lot for joining in. I want to understand your order book from the defense sector at the moment is very small. It's just under 5%, I understand. Can you tell me what kind of revenue opportunity do you see here now that the government is going full throttle in this space? How much can you grow your revenue percentage to from this current 5%? And any opportunities in FY24 itself in terms of orders?
We can't really quantify it right now. The most important thing is that we have applied for the defense license, it's a very long process. We have more than 25 departments to clear the file, and we have just heard that the committee has just, it has to go into the final committee this month or next month. So once we have the defense license, then we'll be able to address the end users directly, like Indian Air Force, Navy, etc. So yes, it's got a great opportunity, but we should also remember that technology is also very important here in terms of the latest systems that we want to develop. So It could be in the form of a joint venture, or it could be what we are developing over the years. So we'll see a lot of traction coming in moving forward, but difficult to quantify the numbers at this point of time.
So Reddy, just a follow-up there. While you're awaiting the license to come through and, you don't have any clarity on the orders, can you help us understand what is the kind of spends that you may have to make to acquire this kind of technology that you're speaking about? Any capex that you have decided that the company will have to put on board? And if yes, will it be largely from internal accruals, or would you have to at some point in time take on some debt as well?
We do have enough capex already established within the company over the years. So that's not an issue, because we have been dealing with defense labs over the last 40 years. So that's not an issue at all. And it's not about technology, buying the technology. It's about doing it jointly in the make and buy portion, or the make and buy formula what Government of India has come about with these defense orders. So that's something which we need to look at. We are looking at a number of companies to jointly associate and take this forward. So let's see how it goes.
So, Mr. Reddy, that's exactly what we're trying to understand. I mean, one route is, like you're saying, getting that defense license and directly dealing with the procurers, which might be the Navy or the Air Force. But there's a huge value chain as well when it comes to defense, right? And, this week we'll have the Prime Minister in the US, and the talk is on technology transfer, a lot of these partnerships, and you're speaking of partnerships. So help us understand which specific segments of defense are you looking at? And at an intent basis, if everything goes according to plan, then let's say in a year, 2 years, 3 years down the line, what percentage of your revenue do you see coming from, or would you want to see coming from the defense space?
See, we are more in the clean energy segment even today, and we will continue to be that. That's our main goal, actually. But defense, yes, probably can. Right now, we are below 5%, but we have the capability of growing it much higher, even to 15 to 20%, or even more. So it all depends on how things progress over the next 1 year in terms of the JVs and in terms of what orders that we can get. So let's see how it goes in the long run.
So this JVs that you're talking about, again, can you give us some sense? These are sort of technology tie-ups, these are manufacturing tie-ups that you're seeking. And again, where in the defense value chain are you looking to get these partners on board?
So both in the electronics area, the electronic warfare, and also the other areas where we can associate ourselves with them. It's only basically not exactly it's a partly a technology transfer in terms of the manufacturing in India. The buy portion will be directly supplied by them, and the make portion is about 50% from the Indian company, joint venture company, and 50% or directly by MTAR as being a prime. That's our goal. And 50% in terms of transferring the technology back from the MNCs abroad.
And the talks are at an advanced stage, can you say? Any timelines? Because you seem to be quite clear that you want these partnerships.
It's important to have these partnerships in order to have a start on some of the latest systems that we are looking at, and that's what most of the companies are doing right now. So, but you need to get qualified for such associations, what we are looking at, and MTAR is well qualified to do that. So we're looking at various options right now, and once we get the license, then we'll take it forward.
Okay, just one final question. Your core business is this clean energy space, from where you get about 70% of your order book. And over there, we've seen a severe margin contraction in the last many quarters. Any indication of a revival? I mean, what can FY24 look like in terms of growth as well as margins? Because that is a big concern that the street has.
I don't think it should be a concern. If you look at our overall margin for last year, it was 27%, when we did say that we were hardly 1% plus minus here and there. So that's not an issue at all. Only the fourth quarter showed a dip of about 25%. That's the reasons we have clearly explained about the employee benefit expenses going higher, because we had to make some market corrections towards the employee salaries and all that. So apart from that, I don't think we have any issues in that area.
All right, Mr. Reddy, we'll leave it at that. Thanks a lot for joining in, and all the best with your license for the defense space as well as, the impending orders there. That is the managing director at MTAR Technologies. Been one of the stronger stocks, actually, up 20% in the last couple of months. Let's take a quick commercial break on that note. On the other side of the break, Anuj will be joining in for a quick trade setup. Post that, we'll also bring you the top stock picks for the day from our technical and F&O experts. Stay tuned.
Okay, welcome back. I think we 12 minutes to go for the pre-open session. SGX is still indicating a lower start. Anuj is here in the studios with a quick check on things. Anuj, morning. What are you watching?
Morning, Prashant. Well, yesterday, the setup was overbought. I think today it's got oversold. The market rejected highs yesterday by just about 7 to 8 points. I think the market should bounce back today. I'm not going too much by the SGX Nifty. And even if SGX Nifty is right, I guess it takes market right into the buy zone. The Fin Nifty expiry today, the last 3 expiries have been quite good. The Bank Nifty is a problem for the market. It defended last week's low, but even then, it's been one index which has been creating problems at higher levels. But the broader market is strong. 6 day of highs for the mid caps. I think today's trade is to buy it open and add on dips. Of course, you have to keep a stop loss, which we'll discuss. The only reason the market could get a bit worrisome is the monsoon progress, which has been quite poor. Not a single day of shower in Konkan, the region we are part of, and June is almost over. Setup, as I said, is oversold. I mean, if you look at FIs and DIs, they both sold. FIs sold in index futures, they sold in stock futures. The India VIX has gone up. The PCR has fallen to 0.98 versus 1.29. All of this gives me confidence that perhaps today's dip could be bought. The first support is at the 10-day exponential moving average of 18,686, and the sacrosanct support is at the 20-day exponential moving average of 18,582. As of now, the texture remains buy on dips as long as 18,582 is holding. On the Bank Nifty, the table will tell you what's the problem. The last 3 days, the high has been between 44,000 to 44,100. The low has been somewhere around 43,500. So that's basically the range. You need to see if there's some stability. It's trading below all major moving averages. If you see the 1-month chart of Bank Nifty, it's really been consolidating. Not fallen a lot, but underperforming the Nifty. In the last 1 month, it's not gone anywhere. It's been in this range of 43,500 to 44,000. You need to play this range if you can. Otherwise, just avoid the Bank Nifty. Focus on Nifty and individual stocks.
In fact, that's so true. I mean, up until now, every year, I think by the 20th of the month, some amount of rainfall comes through. And this time, it's absolutely nothing.
Yes.
Except that cyclone, related rainfall, which was a shower.
Over the weekend, I had gone to, the area between Lonavala and Ambi Valley. It was raining there a little bit, but that's it.
But let's say, that the expectation is that now the cyclone's gone. It was sucking away all the moisture winds. Exactly. Now, the next 3-4 days, SkyMet has told us there'll be a revival.
None of us is an expert in that, but the hope is the.
No, the experts saying that. That's what SkyMet was saying yesterday.
Absolutely, the hope is that at least now. I mean, look, the monsoon has started late, and obviously the June will be deficient, but. It's not rocket science that if you start so late, June will be deficient. But July onwards, if at least you make up for that and the distribution is okay, I think you're still fine. I think it's the point from here on. By the way, this is a big news that the block has happened in block deal window, 2.18 crore. I think today you see a lot of short covering in HDFC AMC. That could well be the stock of the morning because yesterday there was a lot of shorting. It ended at 26 rupee discount. I think that could be your stock of the morning today.
Okay, thanks a lot for that, Anuj. Well, for now, Mitesh Thakkar and Sudarshan Sukhani are also joining in to help us with some trades for the day and tell us how to approach the markets. Gentlemen, morning to both of you. Sudarshan, this market has been struggling to get to all-time highs, but the bigger worry is what's happening with the bank Nifty. And we were just talking about how Kotak Mahindra Bank is down 10% this month already. What's happening here and how do you approach the market now?
Yeah, good morning, Sonia. See, we'll start with the bank Nifty. The bank Nifty chart suggests that it has been in a trading range since the beginning of May. That's a long time. It's almost 1.5 months where the bank Nifty has struggled to go up. Because the broad market is going up, the struggle is to cross the resistance levels. Now, it is possible that this large trading range may actually become a distribution for the bank Nifty. I cannot say. It's possible. So when the possibility of a distribution stares in our face, the trade in the bank Nifty is to completely avoid it. For all I know, it may go up, but now there is a question mark. So don't dabble in the bank Nifty. We'll just leave it alone. The Nifty is in a strong uptrend. But even for the Nifty, yesterday we had suggested buying at 18,725 and the market obliged us by going there. But today is a different day. If the 18,700 levels do not hold during the first 1 hour, then it is best to exit all long positions and step aside and see where this correction takes us. So today, do not enter again. If you have positions, keep a stop at 18,700 and just be quiet.
All right, that's good advice. Gentlemen, good morning. Mitesh, what about you? How are you looking at things?
Morning. So till now, I think, the problem issue was coming from the banking side. And we had suggested not buying the Nifty also because the bank Nifty was not participating. I think there could be now first signs of, corrective setup happening on the Nifty itself. I would be watching this level of 18,680, 675, which was the low which we made on 15th of June. Very, very closely. If we start trading below that low, then I think we are looking at about 150 to about 200 point kind of a corrective pullback to the moving averages kind of a decline. And therefore, the markets might get choppy. The also important factor, the other factor which is also important and which should be watched is your India VIX charts, which I think after forming a base at about 10.5, 11, now I think, could be on the verge of giving a breakout. So I'm watching the chart closely. If we start getting past 11.5 on the India VIX, then there's a good chance that the India VIX is possibly seeing a rally to about 12.5, 13 zone. So then I think, that will also coincide with some kind of a corrective movement. So broadly, I think what I would suggest traders is to cut down on their long exposure on the stock side as well. And in case the Nifty starts trading below 18,670, one can take some kind of bearish positions. Disclaimer that we have some put option. It's a very minor position as to begin with right now, put option positions of July expiry. But even on the stock side, I think I'll advise to take profits on your long positions and then wait for the pullback to play out before going long afresh at lower levels.
That's an important point, and we were highlighting that the VIX, by the way, sold off to under 10 kind of levels and then rallied about 5%. Almost all-time lows on the VIX and then about a 5% rally yesterday. And sometimes it does indicate turns, the India VIX. So let's see if we are at one of those moments. But let's talk about specific stocks. Sudarshan, what do you have?
Well, I have Bata India for buying. The stock has been in a sustained uptrend and maybe you'll get a dip today. Keep a stop under 1600 and look to buy. Make it a positional trade. Gujarat Gas is an intraday short. It has a very poor chart in terms of, say, bullish signs. It doesn't have any bullish signs. So it's an intraday short with a stop above 480. Then I also have IGL, and they both are gas companies coincidentally. That's an intraday short again. IGL is making lower highs, lower lows, a classic sign of a downtrend. Stop above 469. And finally, I have a buying option in Tata Chemicals. Now, it's a high risk trade because it's coming at support. If support breaks, then we have to get out with a stop at 955. If it doesn't break, we get a bounce.
Okay, got that. Sudarshan, thanks for the picks there. Mitesh, let's come to you as well. Though you're suggesting that one should start booking profits even in stock positions, what would the trading calls today be on the stock side?
Morning, Surbi. So after a long time, I have an equal weightage to buy and sell side calls. So 2 buys to 2 sells. IGL features on my list as well on the sell side. So keep a stop at 466, look for targets of 445. And Axis Bank is the other one, which I would suggest selling with a stop at 976 for pullback to about levels of 944. On the buying side is Bank of Baroda with a stop at 188, trying to buy it on the gap down around 191.5 and look for targets of around 200 to about 201. And Lal Path Lab had a very strong breakout yesterday. That could see follow through. So buy here with a stop below 2090 for targets of 2185.
Right. Thanks, gentlemen, for joining in and helping us with all of those ideas. Let's take a quick commercial break. On the other side, we'll have the pre-opening rates, and later we'll connect with Mangesh Bharang, who's the Senior Vice President Research at Centrum Broking, to discuss their top picks in the cement sector. Stay tuned.
Welcome back. We are rounding up close to 9 o'clock. Let's get a couple of F&O trades in as well. We have Manoj Muralidharan for exactly that. Manoj, good morning. Tell us, the market's kind of been teasing the bulls a little bit with the little selling coming through. In terms of F&O action, what would your calls be?
Good morning, Shruvi. Shruvi, I guess the derivative market is quite proportional to the positioning that is there in the market. So let's say the Nifty has close to 99 odd lakhs in terms of open interest. This additional or the last 6 to 7 lakhs of open interest came in once the Nifty crossed the 18,600 mark. So what I'm trying to say is the weighted average price or the price at which this 8 lakh positioning had come into the market last 6 days was somewhere close to this level of 18,600 to 650. So we believe that is a good support. Intraday, 18,650 to 680, that's a good support for the Nifty. We're expecting that to be respected. And the Nifty might start inching more towards an 18,750 odd. So that 100-point trade should be a good level to go long. The stop loss should be 18,600. The second thing is the volatility index, which is closer to 11.5. We need to understand this when the underlying goes up. The Nifty, when the Nifty was 18,000 odd level, that time we used to get a VIX of 14 to 15. Now we are at 18,700. So what the math says that that defines a swing of close to 650 points in the next 30 odd days. Now, though, last month, even if you see at this point of time, we were at a position of almost 1.2 odd crores. So I'm afraid after this weekly expiry, this Thursday, the monthly expiry which comes in, if the positions don't add up, then possible July might be a tough one. But as of now, the bias is positive. 18,650 should be a good level to go long today. The target should be 750 to 780 on the futures.
Any stocks?
Yes, stock specific, we are combining long positioning along with the cash-based buying. So in IT as a sector, we believe Intellect has seen good buying and we expect a follow-up buying. So 615, 616 is a good level to go long. The stop loss should be 610 and we expect close to 628 on the stock. And we believe that India Cement also has seen good buying. So at least from the cement sector, we believe that that can be a follow-up buying with 218, 220 as a support, which is a good level to go long. The stop loss should be close to 210 and the stock has a potential of close to 232 in the short term.
All right. In fact, it's like you read my mind. I'm going to talk about the cement space right now. So thanks a lot for that, Manoj. India Cements is one of the top picks on his list. And let's continue our focus on the cement sector. According to Centrum Broking, Q4 was a good quarter for cement companies. Mangesh Bharang, who's the Senior Vice President Research at Centrum Broking, joins us now. Mangesh, morning. A lot of things are working in favor of the cement sector. Of course, one, growth is picking up. The second is that energy costs have declined quite a bit, and that's a big earnings tailwind for FY24. Just take us through how much of this news is in the price and what are your top picks in the space now?
Yeah, hi. Good morning. So you're right. You said that all the cost headwinds that were actually impacting margins earlier have now turned into tailwinds, and we would actually see for the next 2 quarters that the margin should keep expanding. So we are talking about EBITDA per ton expansion of another 200 rupees on a per ton basis. But having said that, if you look at the stock prices, I think a large amount of stocks are actually factoring in the good news that we would expect in 24 and largely in 25. What we are looking at is FY24, definitely it's a consensus that is going to be a very good growth year for demand growth. But whether that would get followed through in FY25 and whether it turns out to be a really bad year for demand, because we have seen that post-election years, generally demand tends to slack a bit. So if it happens, definitely we are looking at higher capacity additions and no demand growth. So that's why I think one needs to be concerned. And as I said, most of the stocks are above their average EV EBITDA bands, and that's why we would be skeptical at looking at most of them. So we are sticking to the larger ones in large caps and very select mid caps name where we see that the valuations as well as earnings is in favor.
Mahesh, but most companies we've spoken with have told us that any help they get on margins, EBITDA per ton, etc., is largely on account of what happens to coking coal prices, input prices basically. In terms of actual price increases here, but one can only expect that post rains. Is that your assessment as well?
Yes, absolutely. If you look at the pricing, cement pricing has been resilient and stable for the past 6 to 7 months. And that was when the EBITDA per ton was actually lower. And now that we are looking at the expansion, instead of the rise, actually, if we might see some pricing pullbacks when the monsoon starts, that's what we are building in. So for the next 2 years, we do not expect any pricing growth for the sector. And in fact, as I said, there could be some time periods wherein the pricing could actually pull back a bit. If you look at the EBITDA per ton of the industry as well as the sector, we are looking at 1100 rupees to 1150 rupees as EBITDA per ton for the sector. We do not expect it to go back to the highs that we saw during the COVID times of FY21 and some parts of 22.
Okay, all right. I just wanted to understand what is the kind of EBITDA per ton improvement that one can see across the board and also across your coverage universe, and also for individual stocks, which could be the biggest beneficiaries as far as EBITDA per ton is concerned. I just want to put one brokerage view on board. Jefferies put out a note where they said that there is an EBITDA per ton improvement of 200 to 220 rupees across coverage universe, their coverage universe for FY24 versus FY23. You think it could get better than that? And which are the stocks that could be big beneficiaries?
Yeah. So purely if I do the math of what was the average pet coke and coal price for most of the cement companies and what it is trending right now, that should translate to 200 rupees decline in operating cost per ton for cement companies. If the coal as well as pet coke prices slide further, definitely we are looking at least say 300 rupees decline. But so the EBITDA per ton is a function of both costs as well as pricing. So our view is that if there is more than 200 rupees decline in operating cost, I think that gets passed on to the consumers, and we would see some softness in realization, but the EBITDA per ton expansion would probably get restricted to 200 rupees per ton. And the key reason for that is basically competition. So we have seen larger players. We are not basically they are not looking to raise pricing in the market, which could probably help their competition. So that's the reason why any further help on EBITDA per ton might get passed on to consumers.
Got that, Mangesh. Thank you very much for the perspective. By the way, the pre-open rates have started coming in. Market's absolutely flat, just 1 point lower. The stocks of RVNL and the likes of Titagarh, even Siemens, they are going to be in focus today. Now, RVNL in the pre-open is already down 8%. That is because reports are indicating that this mega Vande Bharat train order, where RVNL and along with their Russian partners, they were the L1. They got the large chunk of 120 trains. There seems to be some trouble with that JV, and maybe this could mean rebidding. Well, let's ask Mr. Umesh Chaudhary, Vice Chairman and MD of Titagarh Wagons. Mr. Chaudhary, thanks for joining in. Now, you along with BHEL were L2 for 80 train sets, right? First and foremost, have you heard anything about this issue with the L1 bidders, which was RVNL and their Russian partners? Is there a case for any rebidding because of this?
Yeah, good morning. So we've also heard from the media reports that there is a problem with the consortium of the L1 bidder, that is the Transmash Holding along with RVNL, with respect to their percentage sharing or some other issues. And also we understand that there have been some issues with the sanction owing to the Ukraine war that has kind of some developments that have taken place. Our information is limited to the media reports. We cannot confirm or deny any other news apart from what we have or you have read in the newspapers.
That's fair, God. That was just checking in case you are privy to any further information. But what happens now? How was the contract structured? This is hypothetical right now, but just in case this does turn out to be correct, and just in case RVNL, along with the Russian consortium, cannot fulfill, the first 120 train sets, what happens? Is the entire contract cancelled? The whole thing goes up for rebidding? Or will you continue with your part and you can maybe bid for, if you choose to do so, you can maybe bid for the first part of the order, which was 120 train sets? Is that even possible?
So absolutely that is possible. Firstly, let me clarify that our contract for 80 trains is signed, sealed and delivered. It is not hinging upon the going forward of the RVNL and Transmash Holding deal or not going forward. Now, hypothetically, and this is purely hypothetically, if this tender is for the Transmash Holding is cancelled, and I do not say that it will be, but I'm just saying that since you asked me a hypothetical question, I'm giving you a hypothetical answer that in case it is, and if it comes for rebidding, obviously we would be bidding in this tender again. So for the 120 Vande Bharats. But as far as the 80 Vande Bharat trains is concerned, last week on the 15th of this month, we also signed the final agreement, not only the preliminary agreement, and we have already started the work on the execution.
Okay, so Umesh, you're saying that 80 Vande Bharat trains order is signed and sealed, so that's done. For this 120 orders, can you tell us that do you have enough capacity to execute this if it comes through to you?
See, we are working in an extremely dynamic environment right now. The Indian government is offering opportunities which is unheard of, unthought of in the past. So even as far as Titagar is concerned, or if I can say that our consortium is concerned, we are continuously kind of almost, I would say, reinventing ourselves. So till this Vande Bharat opportunity came up, we had a capacity planned for 20 coaches to go up to 40 coaches. With the Vande Bharat first 80 train order, we have already now started planning to go up to 65, 70 coaches per month. So if there is an opportunity, we will definitely not let go of that opportunity. We have scalability in our system and we will evaluate, again, would not say that we will or we will not bag this order or be aggressive in this order, but we will definitely evaluate the opportunity on its merit and work on it.
Umesh, thanks for clarifying. Thank you very much for joining us. Important that we spoke to you and got that from you. So basically, Titagar telling us that as of now, they've not heard anything, but they'll be watchful in terms of what happens to the L1 order. Now, there's 5 minutes to go for the pre-open session. Sudarshan and Mitesh are with us for their 9-10 call. Sudarshan, what do you have?
I have Bata India. Buy Bata India with a stop under 1600.
Mitesh, what about you?
I think buy on Lalpath Labs with a stop at 2094 for targets of 2185.
All right. Thanks very much for that. Amisha is still with us. Amisha, thanks for waiting. Just a quick word on, Titagar, of course, we already discussed. So nothing, no impact whatsoever to them and their order. I think you also were of that view. Second, any thoughts on HDFC AMC with that large Aberdeen block out of the way? It's a complete clean out kind of trade. Any thoughts?
See, I feel that at current levels of AMC valuations and the fears around some of the new SEBI regulations which talk about curtailing the total expense ratio, also talking about including all types of expenses within. So there is a little cloud around their profitability if one wants to see for, say, next 1 or 2 years. But if you see the penetration in India still is so low that this is one business where the growth has huge legs ahead. So I am very, very positive on HDFC AMC and particularly the AMC space also. And I think that, yes, this block has happened. It has gone into very strong hands and the stock should do well.
Okay, I also wanted to just put the focus back on Indigo because as we know, the company has announced the largest ever order. They've bought 500 planes. They've announced the order to Airbus, and this is in addition to the 310 planes that are already operational and 480 planes that they've already ordered. Now, Amisha, I wanted your thoughts here because this is also at a time when its competitors like GoAir and SpiceJet are both seeing problems, right? Go First with the insolvency issues, SpiceJet as well, some issues cropping up, some flights have been stopped. At a time like this, do you see further upsides for a stock like Indigo?
Yes, we have an accumulate rating. The stock has done really well and possible that after a little good run, it might consolidate. But broadly, we have an accumulate rating. And we think that the space is very interesting in terms of, as what you very rightly mentioned, A, the traffic growth is good and will continue to be good, whether domestic or even foreign routes. And B, the competition is not as strong as one would expect it. So the market share gains are also possible. And being a well-oiled player, I think they will continue to gain. So we continue to remain positive on the stock.
Okay, all right, Amisha, thank you very much for being with us this morning. Always appreciate you joining us on the show. Just before we hit opening, by the way, the pre-open is absolutely flat. So India is not doing as bad as some of the Asian markets. Very quickly, there's some news on JB Chemicals as well. So let's bring Ekta back in. Ekta.
Thanks for that. Well, yes, Jefferies has initiated on JB Chemicals with a buy and a target price of 2,680. According to them, JB Chemicals is the fastest growing domestic pharma company. The growth is led by therapy dominance in cardiac as well as gastro. Life cycle management of key brands, synergistic acquisitions and new launches will lead growth according to them. Export growth will be led by contract manufacturing of lozenges. So they seem to be quite positive on JB Chemicals.
All right, thanks a lot for that. We have 30 seconds left for the markets to open and looks like it's going to be a largely flat opening with a bit of a negative bias. Remember, the key problem area for the market has been banks and that seems to be dragging even today. So IndusInd Bank, Kotak Mahindra Bank, ICICI Bank are all your laggards in pre-opening. Kotak Mahindra Bank and IndusInd Bank have actually been one of the big losers this month as well. ICICI Bank too is down about 3-4% for the month. So, this sort of pocket has moved to the back burner. Let's see how today shapes up. The first tick on the index is flat, very, very quiet, so not moving the needle too much, hovering around that 18,750 level. The mid-caps are also absolutely quiet. The good part is that the advance decline ratio is in favor of the advances, at least at the moment. Big moves. Let's first check out what's happening with the banks because they've been the big laggards. Once again, the Bank Nifty is down about 80-odd points. ICICI Bank is your top loser, followed by IndusInd Bank and then HDFC Bank. So this whole pocket is under pressure. Autos are starting to come off a tad bit now. The rally has been pretty smooth this year and this month. So autos, Maruti Suzuki is down. Eicher Motors is under pressure. So some profit taking is what you're seeing there. And metal names as well. Tata Steel is down about 0.5%, followed by a couple of other metal names, leading the way on the downside. Bajaj Finserv, Divi's Labs, there are a couple of other stocks that are in the red. By the way, HDFC AMC, after that block, is one of the big movers right now. So do keep an eye out on that. And Indigo as well is up almost about 2%. HDFC AMC now rallying about 8% in trade. Talking about gainers, Apollo Hospital is your biggest index gainer right now, followed by SBI Life, Adani Enterprises, and some of the IT stocks are making a bit of a comeback. Wipro, Infosys are trending a tad bit in the green. Titan and Britannia are also holding up in the green. In fact, Apollo Hospital has been the biggest mover this month. In the month of June alone, Apollo Hospitals is up 12%. And, we had very positive commentary from the management, Sunita Reddy, a couple of weeks ago about their digital arm. So that stock is now at almost 5,200. Big moves coming in there. But otherwise, for the market, very, very quiet at the moment. Timken India, there's a large deal that's taken place there and stock completely knocked down.
Yeah, that's something that Nimesh was alerting us about. In all probability, this could be, at least, this block could be perhaps the companies' owners, the foreign parent, them looking to pare down stake. Of course, it's not confirmed. You have to wait for the end of the day to find the identity of the buyer and seller. But the buzz was that maybe some of this selling is happening because foreign owners are cashing out. By the way, check out IIFL Securities. These very strict observations coming in from SEBI. SEBI barring the company from taking any new clients and suggesting that there's misuse of client funds as well. 16% down. That's a huge cash on that one stock. Otherwise, the mid-cap market is very quiet, and this is what we were highlighting at the start, that if the large-cap indices start falling, can mid-caps really continue their party? Well, their party has tempered off, at least for now. Let's see, it's early days. Mid-cap index is very, very flat for the time being. RVNL is down about 4% because of this Vande Bharat issue that we were just discussing. HAL, by the way, has gone into F&O ban. Stock is down about 2% as we speak. So these are some of the movers and shakers in focus. Titagarh Rail, because of what the management just told you. In case the RVNL part comes up for rebidding, Titagarh is interested. 5% up on that stock. Titagarh Rail Systems, yeah, there we go. Up and about. Those are some of the names that are hitting the headlines. Bank of Baroda, positive brokerage commentary coming in from JP Morgan. Stocks up another 1% or so. Actually, even Central Bank of India, some of these PSUs are not too bad. ICICI Prudential up about 1.5%. Lemon Tree, Varun Beverages, Sula. These are some of the other mid-cap names, but it's very quiet out there. The mid-cap index is absolutely flat. The Nifty is the one that's struggling a little bit with a 40-point cut for the time being. And once again, I guess we go back to blaming the banks because it is the Bank Nifty, which is down 0.25% for the time being.
Well, what 40 points lower, 18,715 is where we are at on the index right now. So things are a little soft as we begin today's session. Now, just a few other names before we go any further. So IIFL Securities, we mentioned, is down 15% now. But it's interesting to see on the other side, something like an Angel One is perking up. It's up about 3 or 4% or so. That's a direct competitor, which is up and about. Now, HAL is down about 1.5%, coming up with very large volumes. Timken, of course, that block will happen. RVNL is down 4%. Mazgaon Dock is coming up with a small change. The Bajaj twins were very strong yesterday, both Finance and FinServ. Finance is down about 1% at start. Not just IIFL Securities, but IIFL is also down about 3.5% to begin the day. Again, mentioning because it's got large volumes. MRPL is down about 1.7%. It was a big gainer yesterday. I mean, these are just pullbacks after, basically some reversals from yesterday. Coforge is down about 1%. And you've got Max Healthcare, which is down about 2% or so. Container Corporation, another one, which is coming up with some cuts at this point in time. The reaction on HDFC AMC is pretty interesting because the stock, of course, is the entire sector actually is completely derated over the last couple of years, has not done anything at all. And now there are these TER regulations, but at least the reaction for now, if it were to hold, suggests that maybe the big overhang was also this Aberdeen stake, which now is finally out of the way. And, we'll have more on this on that in a bit. Olectra Green Tech is the number 2 gainer, volume-led gainer, by the way. It was a big one yesterday. It's up another 3%. And look at something like a Skipper. Skipper went up, I think, 15% yesterday. It's up another 7%. So in the broader market, there is a fair bit of momentum, which one is starting to see. Sonia.
I don't know how you read my mind, but I was going to comment on Olectra Green Tech. If you remember, Ravi Dharamshi in our editors round, okay, you weren't there this week, but
he's been a big.
He's very bullish on this entire EV space, especially the ancillary space, not the main OEMs, but Olectra Green Tech is into EV buses. And this year, Prashant, not even 6 months are over, the stock has doubled. It's literally up 100% since January because of, the kind of momentum that we're seeing in the EV space. So this is one theme that's really working out.
Absolutely. Yesterday we had Vijay Kedia with us, who was also talking about EVs as a sunrise sector. And of course, I mean, his big bet is Atul Auto, where, post-pref issue, his stake is about 20% now. So that's, that's what we have. Amber, by the way, is up 4%, 2,200 on Amber. So a few other names. So broader market, at least the breadth is pretty solid. 1,100 stocks are higher and about 800 stocks are lower. The Nifty is down 60 points, so it's drifted a little lower from the start as well. and the mid-cap and small-cap indices are also a little sideways for now. Well, let's welcome in Venugopal Garre. He's Managing Director, Bernstein. Venu, great to have you with us here. Good morning. Good to have you as always. Now, it's a market where you really don't want to stand in the way of momentum or the sentiment, which is very, very upbeat. At the same time, I mean, would you struggle to find large pockets of very clear undervaluation, Venu? So how does one approach things now? Go on.
Thanks, Prashant. I think you have summarized it well. When we start running out of bottom-up ideas, that is when we start to worry about market levels. At the same time, the flow perspective, especially FII flow, seems to be fairly decent. And I think India is also emerging as a very important sort of a country in the overall emerging market basket, which is basically another aspect which needs to be debated, whether it's a short-term sort of a view or a structural view that investors are taking. A lot of these flows essentially then leads to this positivity and momentum, which is what we are essentially seeing in the markets today. Now, our view primarily has only changed modestly. I mean, in some way, I didn't want to really stay away or stand in the way of momentum. About 3 months back, you would recall, last time when we were discussing, we had upgraded India to sort of a buy with the view that index should go to 18,500 levels. Now, that was actually an year-end view. And we ended up seeing that happening in 3 months, or less than 3 months. Now, at this situation, I am of the view that I use this term called positive pause, which primarily means that I'm not looking for a deep correction in the markets, but there is a possibility that we hover around a similar range for Nifty, with room for short corrections happening, episodic factors driving those. At the same time, I think that the broader markets outside of the index stocks probably will continue to see momentum, which is where I guess people would seek opportunities, in terms of investment. So that's the broad roundup view of what I think about, at this juncture from a top-down level on India.
So you spoke about a positive pause in the market. So perhaps what we call a time-wise correction, right? Not so much a price-wise correction. Got that. Venugopal, morning. I have to ask you what's happening with the banks, because, there's a steep fall that we've seen in the month of June. Stocks like Kotak Mahindra Bank are down 10% already, and we're not even done with half of the month, or with the entire month, rather. What do you do at a time like this? Do you buy this dip, or do you stay away entirely from the private sector banks?
My viewpoint is, I think the market's viewpoint primarily is very centered around how they're looking at, the top-down valuations as well. The general thinking is that, larger banks, given what are expectations of credit growth this year, the lack of room for earnings upgrades, for example, doesn't really necessarily mean earnings downgrade revisions, but essentially about lack of room for earnings upgrades and where they are on valuations. I think there's a broader thinking that perhaps they're fully valued, which is what is broadly reflecting in the underperformance, which has basically happened year to date. Now, my viewpoint is that, given a slightly positive view that I have over I would say a 2 to 3 year view, or even a 12-month view, I would be a buyer of these sort of declines in some of these large cap banks. And my perspective simply is that if people think about red flags, this is more about the broad basing of credit growth. Now, so if you were to think about it, if consumption, things like unsecured lending, if that has been essentially been the drivers for credit growth, eventually it has to move and become more industrial led, not necessarily just industrial working capital led by inflation, but more industrial led by capex. And these things essentially take time. But I think the market comfort would essentially come through when that transition happens. Now, this transition essentially on its own will not happen in 3 months. It is going to take about a 12 to 24 month view. So if you are essentially looking at playing that trade, I think it is a good opportunity to essentially buy into these banks. They've underperformed. And I think the cycle is going to be positive for them over a 3 year view.
Okay, so keeping the faith on the banking side of the market, Venugopal, hi, good morning. Let's talk consumer as well, because I guess that's where everyone's now trying to see if this rural revival is for real, but we have questions on the monsoon right now. So, what's your overall thoughts and sort of positioning on the consumer side of the market? And if you could break that up between urban discretionary and let's say some of the more ground ground level rural FMCG part of it?
Yeah, so I mean, consumption has various subparts to it. I think on an overall level, I am still sort of underweight on consumption. And in the sense that from a growth standpoint, my viewpoint is consumption may not necessarily throw major positive surprises. And remember that the start for the monsoons has not been that great. So there are some risks around what might happen to agri GDP growth rate, which is, of course, got a deep link with how monsoons shape up. So at the margin, what we saw positivity in terms of rural spends in the initial part of the year, perhaps we could see a situation where things might moderate, in the next 2 or 3 months. Now that's essentially probably, worrying sign. Now I would probably argue that within these elements of broader consumer, the areas which I have actually been pushing or been positive on are more linked to things like appliances or electrical products, which could be those products associated with the real estate. So that's an area essentially I'm positive and overweight on. That's a change that we had made a few months back. FMCG in general, very hard to argue for incremental positives given where they are on the valuation cycles. I would still be underweight pure FMCG. Autos, which is another leg of consumption. This part, I was more neutralish in trying to play with certain stocks in the basket. Of course, it's a positive sort of a view on autos, but neutralish because of specific, sort of areas where we weren't really positive on. But at this juncture, I think we're reaching a situation where it's becoming hard to digest even valuations for autos across the board. So incrementally, I guess the returns will be quite relatively more muted even in that particular sector. So that's a broad probably picture I would sort of place. If at all, I would probably argue that discretionary outside of all this, I guess might still be a bit sluggish because inflationary risks, while, sort of are receding, but then aspects such as inflation rearing up back again because of food and other things might be a risk which might play out later in the year.
What about some of these spaces that have come back after a long time? I mean, defense, of course, has been the flavor of the season now. But there are so many other pockets, right? Auto ancillaries have come back in a big way. Electric vehicles, we were just discussing that theme a while back. Anything that you like from these so-called new age themes?
No, I think we like a lot of these themes, but there are some themes which are getting priced in. For example, defense, I've been positive on it for almost a decade. And looking at where they are currently on the valuation curve, very simplistic view, if you were to think of defense, the idea was that indigenization essentially will drive faster growth for local companies, especially the SOEs. If you were to look at 8-9% long-term growth historic from a top-line perspective for the overall defense spends on the capex side of things, now these companies are already pricing in more than double of that. Look at where they are on valuation curve. So I think the defense theme is fizzling more for me from a point of view of valuation than essentially the story itself. The second theme, essentially on the EV side of things, I'm very, very positive. I would be of the view that mainstream EV companies are yet to emerge. So people are trying to essentially play whatever is linked to EVs at this juncture. And one should be really cognizant of that. Essentially, some companies which are just assemblers and conduit for Chinese companies, without mentioning those names, I think one should be extremely careful about sustenance of those rallies for those companies. I would still wait for some of these incumbents and mainstream EV companies to emerge to essentially call that as a relevant sector. Manufacturing is another area where I'm really positive on, especially the China Plus One theme. There would be a broad basing of opportunities essentially that I see around that as well. And that's a pretty long-term theme, so you will always see volatility around that. So these are probably the three things that I want to mention as the area. So,
Venu, have you? The institutional investors, they have certain criteria in terms of market cap, volumes, etc. And that kind of, in a market like this, because there are newer sectors emerging as well, right? Smaller companies which cater to, as you yourself said, one has to be more careful there because they're not established in the electric vehicle space, for example, and other areas. So, I mean, do investors want more ideas down the market curve? I mean, just trying to understand, because there is new energy, there is electric vehicles, defense, for example, there are lots of smaller companies, not the big ones like BEL, where there is institutional coverage. But is there interest down the market cap curve?
Yes, Prashant, I think somewhere down the line, I think broadly, globally, investors have realized that one of the most important ways to play India as a story is not just through large caps. Otherwise, it always used to be the top 50 or 60 companies. So the interest in trying to achieve those opportunities where you could essentially sit with companies and get your multi-baggers essentially comes through those, the next 50 or the next 150, right? So we don't really see too much of interest in a 300th rank market cap stock, but essentially outside of the top 100, the next 150, there is immense interest because people do still want to essentially achieve some part of the portfolio linkage to those sort of stocks, which can essentially give them, sort of the extra return over the index. So that's, I think, given. And I see that actually getting broad-based across the world. So that's the situation at this juncture. But at the same time, I would probably argue that, somewhere down the line, these new opportunities that come through, there are some areas where I see much more tangible interest. So for example, something like EVs, there is always active participation in trying to figure out what to buy. Similarly, manufacturing in general, fairly active participation. Manufacturing could be EMS or could be an existing manufacturer doing, let's say, even chemicals, right? So that's like a fairly broad industry. But, at the same time, new energy, I think there is a divided opinion in terms of quality of companies and what to play, whether it should be a utility or a manufacturer. And I guess probably, I think the opinion is very clear that people want to still figure out and play manufacturers rather than trying to play utilities because there's some always regulatory issues which emerge, right? So there people tend to discern about what to buy and what not to buy. And similarly, just to highlight EVs, as I mentioned, want to clearly clarify that while people in the lack of opportunities might be buying whatever appears as EV at this juncture, if you are a company which are just a front for a Chinese EV player, I think those are companies which won't be sustainable. Eventually they will find regulatory issues.
All right, we'll leave it at that. Thanks a lot for joining in, Venugopal. Appreciate your thoughts. By the way, I just want to point out that the market has taken a big turn for the worse. So after yesterday's steep slide, that caution has been taken forward today as well. The sensex is down 300 points and the nifty is down almost 100 points. It's given up on 18,700 with a lot of ease. And don't lose sight of what's happening with the bank nifty. The one stock that I just want to point out is IIFL Securities. Now, we spoke about that in our top 10 segment as well. But the stock is down 15% after SEBI prohibited IIFL Securities from taking on board any new clients for the next 2 years. So, because of that, the stock is under a lot of pressure. But overall as well, the market, deep shade of red now.
Yeah, absolutely. I mean, it's in sync with what we're seeing across Asia. This is not an India-specific thing. We should pull up the Hong Kong market actually once again. Look at this. China has cut rates along expected lines, but markets in a very different mood. Global markets are in a different mood. Hong Kong's actually down about 1.5%. So profit-taking seems to be the order of the day. Let's see. Now, we have to wait for the mothership when the U.S. markets reopen for business today and see if that can change. But right now, it just seems to be a very, very cautious outlook. Maybe it's just pricing in the reality of more hikes ahead. I mean,
the Hang Seng market, I think, is very focused. I mean, the reaction is because of China, because I think the cut has happened, but it is lesser than expected.
It's only 10 basis points.
There has been also expectation that they will announce many more stimulus measures.
The fiscal stimulus.
The China market goes into holiday starting Thursday. So, I mean, it has to happen before that.
Right.
Otherwise, I think the Hang Seng market perhaps is
extra
very specifically China.
Absolutely, fair point. I mean, everyone's waiting for these property market measures in China. I mean, that would be the big thing. And right now, we're seeing only incremental cuts. So absolutely take your point, Prashant. Perhaps that's where the disappointment seems to be coming in from. We've got an eye on the screen for sure, but let's also continue the corporate conversations. That's a nifty for you. It is a big slide. And like we were pointing out, when the headline indices start falling like this, can mid-caps really remain resurgent? Perhaps not. So there's profit taking in the mid-cap market as well. That is the order of the day. It's a red screen across the board. But let's keep the conversations going on the corporate side. And Star Health is the next corporate on our radar. The company's net earned premium in the fourth quarter was up by about 11%. The company's been guiding for a premium growth of above industry levels as well for this year. And they seem to be quite optimistic of an overall good performance in FY24. Anand Roy, MD at Star Health and Allied Insurance, is with us. Mr. Roy, thank you for joining in. I just want to start with the May premium trends. And if we look at it, I think the standalone health insurance industry saw a premium growth of about 23%, if I'm looking at the right numbers. Your growth was around 16%. Tell us what the outlook is. I mean, what are the average monthly rates that you will target, given that I think there's been a fair amount of price hike as well. Are we done with most of the price hikes? Will we see more this year? And what is your outlook on the monthly premium run rate?
Morning, and thanks for having me on your show. So our outlook for this year, we believe that we should be able to deliver 20% plus growth rate in our premiums. And that's what we are clocking as on the YTD numbers, which is higher than the industry growth rate on the retail side. The industry is growing at around 18%. We are growing at 20%. On the overall basis also, we are clocking a 20% growth. So I think that's the momentum we would like to maintain for a medium to long period of time. You know, the intention and the aspiration is to maintain a 20% healthy growth and also have a reasonably good combined ratio of 93 to 94%. And if we are able to deliver both on these numbers, I think the company should be, able to deliver a 20% ROE on a consistent basis. I think these are the numbers that we are trying to achieve, and we are planning our strategies towards that.
So, Mr. Roy, just to understand, when you said 20% growth in premiums for this year, is that largely volume growth that you're talking about, or you're also expecting or building in an element of higher prices, higher premiums? I know I've been paying more for my health insurance, for instance.
So premium hikes, we have taken a premium hike in one of our leading product, the Family Health Optima, and that will play out throughout this year because that effectively came into being from May, that is last month, for our existing customers. So I think for the next 12 months that will play out. We are seeing, reasonably good trends. The customers are remaining in the franchise, and we are tracking that very, very closely. So I think the premium growth, the growth will come from both, as you said, from the volume growth as well as the value growth on maybe on a 50-50 basis. But that's what we are trying to do. Yeah.
Anand, our team points out that a similar price hike, which was taken back in 2017, did drag renewal rates down by about 4-5%. Have you, because this came into effect on the 1st of May, this price hike for the Optima plan, have you seen, I mean, it's too early, but have you seen anything of that sort, and do you expect a repeat of what you saw back then?
So Prashant, yeah, that's right, because typically we do see, we would expect a 4 to 5% drop off in our, probably some customers, but we do not expect any downturn in our overall premium because if there is a 3 to 4% drop off in our customer from this particular product, the overall premium rates would remain better than what it was last year in terms of because of the price hike. So that is already built into our strategy. We are trying to minimize that to the extent possible by convincing our existing customers to, if they are not interested in the FHO, they can migrate to one of our other products. So I think that's already on. We hope to, reduce that impact to the maximum possible.
Okay. Also, I guess, on your strategy has been increasing market share, right? Because your retail market share has gone up to almost 35% now. What are the steps you're taking to increase it further? Is it more to do with geographical rural penetration? And, what kind of market share are you targeting, say, by the end of FY24 and 25?
So, Sonia, we have been focusing on the semi-urban and the rural markets in a big way. More than close to 25% of our business already comes from these geographies, and we are having a very, very intense focus on that. We expect to open about 1,000 new sales offices in the semi-urban and the rural markets and increase our penetration in those areas. I think it is also aligned with the regulators, strategy to increase penetration in the country. So we are looking at the Bharat, as you may call it, rather than only focusing on the urban markets. So maintaining market share definitely is an important, strategy for us. As you rightly said, we are at 35%, which is way above the other competitors. But growing it from there by growing faster than the industry, I think we should be able to accumulate the market share slowly.
So this, increase in the rural footprint that you were talking about, right? Earlier you had told us that you're looking to do that via more bancassurance tie-ups and agency channel tie-ups as well. Tell us a little bit about that because I think the contribution of tie-ups with corporates and banker channels has been about 43% in FY23, if I'm not wrong. How much could you take that up to by the end of FY24? And is that your main strategy with which you'll sort of increase your rural presence?
So it's a mix of both. We have a very strong agency network. We have more than 650,000 agents who work for us across the country. So in the rural markets, obviously the agents will continue to play a very big role. But on the bancassurance side, as well as other partnerships that we are having, which is growing very fast for us, I think, they will also start contributing. As a matter of fact, we have recently signed up with India Post Payments Bank, and they have a very strong rural presence. So we hope that, partnerships like these will bring, more momentum in our rural drive. So it is a mix of both agency and non-agency channels that will give us the momentum.
Okay, we'll let you go on that note. Thanks a lot for joining and appreciate your thoughts. That's the word coming in from Star Health. Let's slip into a quick break. On the other side, we'll connect with the management of Endurance Technology and find out how export markets are doing. Remember, that's been the big theme across most OEMs, a pickup in exports. Ramesh Gihani, the Executive Director and CEO of Endurance Technologies, will be joining in to give us an outlook on the business. We will also connect with Vinod Agarwal, the MD and CEO of Volvo Eicher Commercial Vehicles, to discuss about Volvo Eicher's deal with BHEL to come out with hydrogen cylinders for commercial vehicles. More on that coming up in a bit. Welcome back. As promised, Endurance Technology is the next corporate joining us on the show. Now, if you look at the commentary from a lot of OEMs in the past couple of weeks, the narrative is that exports are picking up. Endurance gets about 25% of their business from the European markets. Earlier last year, the market was very challenging. But in Q4, earnings actually picked up because of the fall in energy prices. Ramesh Gihani, the Executive Director and CEO of Endurance Technologies, joins us now to give us a sense of the demand environment. Mr. Gihani, always great speaking to you because we get to learn a lot about the industry, not just about your own business. Is the worst of the export problem behind us? Not just the problem with energy prices, which has of course fallen, but demand in general. How is it at the moment?
Thank you, Sonia. Good morning. It's a pleasure talking to you too. Well, as far as export is concerned, right now, what we see in Europe, what is happening is that, yes, the registrations are increasing, the numbers are increasing. Like the increase was around 17% in the month of April. But the other sound bites that are coming in is that Europe is worried about inflation. They're not used to the inflationary part, which is close to 7.5% right now. And, because of this reason, people are not buying vehicles. What is being sold presently are those vehicles which were booked probably 18 months back. So the sentiment is a bit low, but I would say that the numbers are coming back. I would always like to look at it from an optimistic view. Yes, the numbers are coming back, right? This inflation, I'm sure they will be working around, the governments and the industries will be working around that, and things should ease out probably in the coming days. As far as energy prices are concerned, yes, they have considerably come down, significantly come down, which is a very positive sign. In Q4, probably the incentives or the payback which came from the government agencies and others was a big help, and that's why you must have seen that the numbers of Europe have increased and the margins have also increased.
So what does this mean, Mr. Gihani, for margins in FY24? I ask because, in Q4, your European business margins turned around quite a bit, as you said, because of lower energy prices. It's almost at 18% now. Can you do better than that? Do you have more margin levers, particularly for Europe in FY24?
Yes, why not? Because currently also, if you see, the energy prices are just about double than what they were in FY19. So if that eases out, you can see that the margins would further improve in Europe. Secondly, we've always been at those levels, 18 to 19% in Europe business. So I see absolutely no reason why we cannot reach there as the situation eases out further on energy prices.
Mr. Gihani, and overall margins between 13 and 14%, sir, for the full year, that is doable?
For Endurance as a whole?
Yes.
Or,
as a whole.
Yeah, why not? See, I think Prashant, I explained this to you last time also. Endurance is a very focused company as far as margins are concerned. There are some challenging factors which are hitting us also, like energy prices in India have also gone up, PNG prices have gone up. But the kind of work that we do behind to keep our costs under control, I see absolutely no reason that why we should not be improving our margins in the coming years.
Mr. Gehani, hi, morning. Just want to understand where your EV order book stands right now. And also, as you go about executing the EV order book, in terms of a revenue mix, how much of the business is going to be EV and how much will be non-EV? If you could maybe give us a projection for FY24 and more importantly, say FY25, 26 onwards.
Yeah, good morning, Surbi. Our total order book for EVs is just about 600 crores, and out of which 378 odd crores was booked in this year. And that's primarily on brakes and castings and the suspension business. So this is what we have acquired so far, and we are in very, very active discussions with our prospective customers, and we've got very promising numbers coming ahead as far as the order book is concerned. It's just about winning them and and putting them into execution. We've already started our brakes business for our customers. We've already started suspension business, so that is going on pretty okay, and I personally believe as the electric vehicle momentum gathers up, we'll be able to increase these numbers.
So I just want to understand in terms of margin profile as well, as you scale up on the EV side of the business, is that a better margin business at all? Or it doesn't really matter whether it's ICE or EV for you in terms of profitability and margins? Are both segments the same?
See, that's a fairly good question, right? Let's try to understand that the configuration of the vehicles are different. So obviously the products that we supply are a bit different than what we supply otherwise. So in that case, some profitability improvements we have over ICE, but not as significant that it can make a considerable difference of pricing, or margins. But they are definitely better than ICE.
Okay, better than IC engine margins. Of course, we understand that, and that overall kit value also goes up for OEMs and for yourself. I want to also understand what does all of this mean for FY24? Because FY23 ended with a revenue growth of almost 17%. You're now sitting on a base of almost 9,000 crores in terms of revenues annually. How much can you do in FY24? Will it be another 17-20% growth? Can you do better than that? And will a large part of the earnings come in from exports? Or are we looking at the domestic business picking up as well? Because here in the domestic market, the revenue growth has been in single digits.
See, there are 2-3 levers to this question. One is that the overall industry did about 19.51 million vehicles last year. Currently, they're floating at the same average, 1.59 or 1.6 million vehicles a month. April did 1.59, but May did 1.73 million vehicles. That's one aspect of it. Within the current circumstances of exports being subdued, or the exports not picking up as much as they were previously. So as the export market comes back, right, we can see a lot of numbers getting added, and for that nobody has to add any capacities. These capacities are already available. So ramping up further numbers because of the export going up in South Africa and in Latin America markets. All these things are positive levers towards improvement of revenues. As far as the OEMs are concerned, we have...
Sure, I'm just running short of time. Can you give me one number? Are we looking at perhaps 10,000 crores of revenues in FY24? That would be about a 15% jump from FY23. Is that a reasonable assumption?
Well, you know very well that I don't give forward-looking numbers, but 10,000 crores is only a number. Why don't you think that we can even surpass that?
Now, I'm being conservative. You don't have to be. You can do even 20%. That's what I'm asking you. I mean, can you do better than what you did in FY23?
Well, we've always been saying that we'll outperform the industry, and that will be our continuous endeavor. How many percentage more or something? That's only time which will tell.
Okay, Mr. Gehani. Good chatting with you. Thank you very much for giving us a sense of on how your export business is shaping up, EVs, the entire gamut. Thanks for joining in. Well, we're sticking with conversations from the auto space. Volvo Eicher CV has tied up with BHEL for hydrogen and CNG cylinders for commercial vehicles. We have Mr. Vinod Agrawal, MD and CEO of VECV Eicher Motors, with us to discuss this. Thanks very much for joining in, sir. So first things first, can you tell us a little more about this tie-up? What's the revenue potential, and how will the revenue be shared? What's the revenue and profit share in this JV?
This is fundamentally a joint development project for CNG and hydrogen cylinders, fuel cylinders. Currently, if you look at CNG cylinders, are all steel cylinders. what we are tied up with BHEL is that they will develop latest technology type 4 composite material cylinders, which are very lightweight and latest technology. And they will also develop the hydrogen cylinders. So these are the latest technology cylinders, and currently this technology is not available in India, and it will take around 2 years' time to get to the production stage. And by the time you will also have the hydrogen gas availability or infrastructure also will be better. So therefore, it is very difficult to tell you about that, what will be the revenue or the implications on the overall profitability. But at the same time, this is for the future technology and for facilitating alternate fuels at the right cost and at the right technology. So it's
Actually, a lot of sure, Mr. Agarwal, good morning. A lot of commercial vehicle players like yourself, Ashok Leyland, are going big in this alternative energy space. So I get that hydrogen fuel is the way to go. But, I guess my colleague was also asking you to understand whether there is any kind of investment that you would have to make in this. You said it will take 2 years for this technology and this whole process to come through. But in those 2 years, any investments that have to be made from Eicher Motors' side?
We are making investments in the hydrogen technology as such. As far as BHEL is concerned, they are making investments for development of new composite material, hydrogen and CNG cylinders. So they are doing one part of it. The entire other thing, investment is being made by us.
So again, sir, just to understand the math, the end product will be these hydrogen cylinders, which will find application in the CV space. So the investments pretty much happening 50-50, is it 30-40? And my similar question for revenue, whenever the revenue kicks in, you said it's 2 years from now, is it a 50-50 revenue share, or what are the terms of engagement here?
No, it's not revenue share. We will be buying these cylinders from them. They are going to develop and manufacture. So they will become the suppliers of these hydrogen and CNG cylinders, which are very lightweight, and we will save on the payload. Like our trucks will be able to give better payload with the lightweight of these cylinders. For example, the CNG cylinders today, we lose payload of around, you can say 700 or 800 kilograms in a truck. With this lightweight cylinders, you will be able to save that weight. So they will be the supplier. They are developing this technology, and we are going to jointly participate with them, and then we will buy these cylinders from them.
Okay, got it. Let's move on now to the overall business as well. Just a couple of checkpoints for you. The month of May was very good. It was almost a 12% growth that you saw in the commercial vehicle sales. How is June and July shaped up, or how is June shaped up, and what's the expectation for July in terms of growth?
Commercial vehicle industry per se is in the, I would say it's in good shape, even though first 2 months figures are not very encouraging as far as the overall industry is concerned. But there are reasons for that. There is no you can say there is no macro reason for any concern. The industry is growing, and it should continue the growth path. Fundamentally, the first 2 months, one thing was that there was changeover of technology to OBD2. So whenever the technology change happens, there is always some sort of uncertainty, or people wait and watch. The second reason is that there has been a lot of, you can say, focus on reducing the discounts across the industry, because discounts have been hurting the industry very much over the last few years. And of course, there is a good realization that it cannot go on like that. For example, we have not been able to recover the right. We have not been able to pass on the cost increases in the past. So now, therefore, if there is expectation of better prices or passing on of the cost increase, so there is some resistance coming from the customer. That is the reason for first 2 months that why the industry figures are not that encouraging as it was last year. However,
sure. For the full year, sir, you had said that FY24 the industry will grow in double digits, and I think that is the view echoed by your peers as well. When you talk about double digits, what would it be? I mean, would it be in high teens? Are you looking more about 10-15% growth? And where would Eicher feature on that list? What kind of growth would you do in the full year?
It will be a different percentage for different segments. For example, for buses it will be very high double digit. Buses already first 2 months also the growth has been more than 30%. So the buses which had been low, even though last year buses was very good, and some of the bus segments also were at a new peak. So this year also the buses demand is very good. Heavy duty trucks also the growth will be better than the light and medium duty trucks, because heavy duty trucks are still away from the earlier peak. So therefore you will see, you can say, better double digit in heavy duty trucks as well as in buses, but in light and medium duty trucks the growth will not be that high.
Okay, so overall, can you leave us with a rough estimate? Talking about the overall CV portfolio, growth of 15, 10, 12%. Any rough range that you'd expect?
I think you can take 10% plus.
10% growth in CV sales this year. All right, we'll remember that, Mr. Agrawal. Thank you very much for joining in. You have a good day, and we look out for the next conversation that we will have. Thanks for joining in. Well, with that, we do have to take a... Actually, we have Mitesh with us now. I think we can go to him. Mitesh, so I think it's a slippery market. So what is the advice from here on? Though now the Nifty is trying to find some ground. What's the sense?
So I think, as I said, the market lacks momentum, but fortunately we haven't had a breakdown below this 18,670 mark. We did venture 2 points below that on an intraday basis. But let's see, if in case we get an hourly closing below that, and to my understanding, I think that's a stronger probability given the fact that, the intraday indicators are turning south and the volatility indicators are turning up. So I think once you get an hourly close below 18,650, 660 zones, then I think, a corrective movement to 18,550. That's the minimum, but logically I would expect 18,480, 450 zones to be tested. So I think next couple of days could be slightly choppy with mild bias on the negative side. A pullback to the 20-50 averages could happen. Therefore, I think, we maintain our bias of cutting down on long positions and exploring short ideas. So I have Concor as a stock recommendation. That's a sell with a stop at about levels of 650. Look for targets of around 600 over here to begin with, and maybe even lower levels can be tested. And the other one is a sell on Ambuja Cement, which also, has given a negative kind of a trigger on the hourly chart. So here, sell with a stop at about levels of 455 half for targets of around 432.
Okay, that's on Ambuja Cement. I wanted your thoughts also on Interglobe Aviation, Mitesh, because that is that stock has hit a fresh lifetime high today. I agree that it's already up about 60% in the last 12 months, so maybe a lot of the juice is out. But do you still see more upsides here?
Looking at the medium to longer term charts, I'm extremely positive on Interglobe Aviation. I think the big thing happened about levels of 2,200, and since then we have seen the stock keep making newer highs. I think a medium term target is around 2850 over here, so good upside left. And if somebody's holding it out, I think keep a stop below 2330 as a positional stop loss, and I think maintain your long positions.
All right, we leave it at that. That's Interglobe Aviation. The market cap of Indigo is now at 94,000 crores. So it's up almost 60% in the last 12 months and almost inching towards the 1 lakh crore mark in terms of a market cap. Let's do one thing. Let's slip into a quick break. On the other side of the break, we'll shift focus to the commodity markets. Manisha Gupta will be with us. We'll also talk about some stocks that are on the move. Stay tuned.
Welcome back. So for the equity markets, it has been a bit of a downward morning. 50 points lower on the Nifty, slightly better off than where we were, let's say, at around 9:30. But it is still a day of decline so far. Let's, however, look at the commodities universe and figure out what the action there is like. Manisha is back with us. She's in the studios now. Manisha, what do you have your eye on?
Well, I'm looking at metals as a sector, but more towards precious metals and then some towards base metals. I'll start with gold prices, where we are trading around $1,950 per ounce right now. Remember, for this year, we've seen an all-time high of 2,050 as well. So we've seen quite a bit of a decline coming in from those kind of levels. And then apart from that, it is also the fact that you're trading at a three-month lows there. China cutting its prime lending rates for 1 year to 5 years by 10 basis points. It's something that seems to be weighing onto the markets here as well. And then apart from that, this one done, the next thing to watch is going to be the US Fed Chair Powell testimony before Congress. That's happening tomorrow. And on Thursday, you have Bank of England monetary policy meeting, where the expectation is that you could be looking at 25 basis point of a rate hike coming in. But more important to watch is the CFTC data, because that tells you on what the fund and money managers really seem to be doing. So the speculative longs are at a 3-month lows when it comes to gold prices, is the reason it seems to be meandering around these levels. So when you look at the overall contracts, we've seen longs go down by 10,000 contracts, but even then it's a big number at 110,000 contracts, which are still on the long side. So when you look at shorts, that has continued to increase by 8,000 contracts here. So shorts in any case is less in number, and that is the reason you have gold prices trading around these 1950 mark. Silver on the other side really seems to be trading on a stronger side. So $24 per ounce is where it really has been holding. 10 to 20 cents down or up is where it has been holding its range for last month or so. Here, the speculative longs have increased by 30% in last 1 week. We've seen longs gain up by 1,400 contracts, and the shorts as well have come down. And this also is a strong number of around 1,200, 1,500 contracts in front of you. Copper prices, trade a look at that, because we're trading at a near 1-month highs when it comes to copper as well. Here, the longs have risen by 5,000 contracts. This is as per the CFTC data. And here, the shorts also have seen a bit of a decline. So the copper prices, after hitting almost a 7-month lows, are trading at a 1-month highs right now. The China, what they've done in sense of interest rate really seems to be supportive, with markets anticipating that you could be looking at further liquidity injections, and that clearly has been yet another supportive factor.
Okay, thanks a lot for that, Manisha. So that is the commodity space. But let's do one thing. Let's talk about equities. Yet again, HDFC AMC is by far the stock of the day. Nimesh is here to tell us more about that. He's also talking about Timken this morning. Nimesh, over to you.
Hi, Sonia. I'll start with HDFC AMC first. A big reaction to the stock after a large block deal. The stock is up 5-6% after the block got executed in the block window, which means there was zero slippage, and the fact that it happened just at a 1% discount versus the anticipation of a 5% discount. So that's the reason why you're seeing a sharp reaction to the stock as well. In terms of information, Aberdeen has sold out its entire 10.2% stake in the company. And in terms of buyers, I understand some domestic mutual funds and a leading long-only fund was an anchor investor in HDFC AMC block. Now, in terms of further implication, because Aberdeen was classified as a promoter and now they've sold out, the free float goes up, which means early next week, FTSE is likely to increase the weight on HDFC AMC, which would lead to an inflow of close to $17 million. But the bigger event to track would be the MSCI, how that treats the stock. Now, there are some sales notes which suggest that the stock, HDFC AMC stock, has to react another 10% on the upside for a possible inclusion in the August reviews. That's the overall analysis as far as MSCI is concerned. So the news is Aberdeen has sold out completely, so it's a clean out trade, and some good funds have bought. Now the action to watch would be what the FTSE does and what MSCI does. FTSE should happen next week. MSCI should take some more time, and the August review is what is likely to include HDFC AMC into MSCI.
Okay, all right, got that. Thanks very much, Nimesh, for the details there. That was a big highlight in terms of the morning block trade action. Manglam is joining in. I think he's watching out for Concor. What's happening here, Manglam?
Well, Container Corp is lower in today's trading session. There's an interesting note which has come in from Kotak, where they've downgraded the stock. They already had a reduced rating, and now they believe that it's time for downgrade to sell. Though they've maintained their target price on the stock at around 610 rupees. That's largely because they've rolled forward the estimates from FY24 to FY25. The important part about this report is that they're sensing a zone of margin correction and uncertainty for the company. Why is it? because they access some data from industry sources, and it suggests that the company has taken a price cut of around 8 to 9% in their key sub 20 metric ton category across its key ports from the 1st of May. In fact, they've taken a higher price cut of almost 12% in the export pricing in the Pipavav port. And this is the first such instance of meaningful pricing cuts by Container Corp over the last 5 years. And this may actually reduce the premium that Container Corp charges to its other competitors as well. And more importantly, from October 2023, there will be a change in the CMD of Concor. So that opens up the scope for accelerating cuts, or that may be the strategy of the new management, is what they are guessing. Also, their thesis is that competition coming in from peers like Gateway Rail as well as Adani Logistics will only increase the costs and pressures for Container Corp. So that means that in the near term, there could be margin uncertainty for them, and as a result of which, it's better to sell.
All right, thanks for that. Well, Nimesh is also tracking Timken this morning. Nimesh, why is that?
Hi, Sonia. So even in Timken, there was a large block, nearly 8.5% equity got changed hands. The promoter entity, which is the parent, was a seller in today's block. The block happened around 10% discount, and then you've seen a bit of a recovery as well, largely because some domestic mutual funds were anchor investors in the Timken block. So the promoters have now sold 8.5% stake. Their stake goes down from 68% to around 61%. It was a bit mysterious that why the parent has sold and raised $250 million by selling this particular stake. But in terms of buyers, some domestic mutual fund is what I understand, were buyers in today's block. So the block happened at a 10% discount, and after that, some bit of recovery in Timken as well after a large block by parent.
All right, thanks a lot for that, Nimesh, and thanks to Mangalam as well for giving us all of the buzzing stocks. Let's slip into a quick break. On the other side, our special Indianomics segment coming up. Lata Venkatesh will connect with TT Jagannathan of TTK Prestige, Atul Lal of Dixon Technologies, Anuj Poddar of Bajaj Electricals, and Akshay D'Souza of Bizom to discuss the demand trends in the consumer durable sector. Stay tuned.